Anup Maheshwari, Head of Equities, Corporate Strategy with DSP Blackrock joins us. Anup, fantastic to have you back and thank you for joining us. Anup, in between our last conversation, nothing has changed. What has changed is the market mood and underlying volatility which has made a comeback.
Yeah, absolutely. I think it's bound to happen, as valuations get a little more expensive, as earnings haven't been up to the mark, you're bound to see some volatility. And it's also a function of what global flows and global markets are doing. So that's part and parcel of equity investing, so it's fine.
Are you slightly worried or disheartened with the earnings season? We may be in a bull market, but the earnings setup is reminding me of a bear market scenario. I have never seen such a sharp earnings downgrade. Estimates are getting slashed and earning estimates are getting reworked.
Yeah, that's true, Nikunj. Earnings have in absolute terms not been up to the mark, but I would say the breadth of earnings is actually better if you actually look for the positives. And at the end of the day, the market is really looking more at forward earnings than what has just occurred. Right now we still don't sense any dramatic reason to scale down next year's numbers. I think a lot of changes can happen in between. More importantly, if you look at the index now, about 60% of the index is in very more defensive like companies with earnings growth anywhere between 10 to 15%, which at least puts a floor on growth. Now the key question is the balance 40%, which has been more volatile in terms of earnings growth. At what point does that turn? Because when it turns, then it will probably surprise on the positive side, and you will see an enhancement to earnings growth as well. But for now, yes, if you look at the absolute level of earnings, it's a disappointment, but the breadth isn't as bad.
Anup, hi, morning. So, which pockets would you say are the earnings disappointment already in the price? And, one looks at the PSU banks and one really wonders whether the negatives are already priced in, because the kind of move that you're seeing in the banking pack of late seems to be indicating that perhaps, the worst may be over, or at least the market has absorbed all the bad news.
Yeah, well, the challenge in PSU banks in particular is, while obviously valuations are very cheap and we like it from a pure valuation basis, but growth continues to be a challenge, capital raise continues to be a challenge, and you do need those ingredients in terms of when you're looking for price appreciation relative to other choices that you have. So it's we've been looking at PSU banks and building a little bit, but frankly we haven't reached the point, in our opinion, that the mix between private and public needs to change much in the portfolio. So the private sector banks is still a more dominant part of the portfolio, because you do get growth, albeit at a higher valuation. But for the PSU banks, I think there's still a function of time in terms of their capital raises and growth to come back. ROEs generally have got impacted structurally because of this combination right now of low growth and lack of capital availability and low valuations.